The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A new week with new tariffs, new inflation data, and a fresh round of earnings. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking you off to the closing bell here in the U.S. What started off as a muted day has actually picked up a little bit.
Yeah, absolutely. It's going to be even greater later in the week.
All right, let's take a look at where things stand right now. Modest gains across the major indexes, even with all the tariff threats. The S&P 500 at 6270 at the moment. But the big mover on the day has really been Bitcoin. Now up only 0.4%, but it did pierce the $123,000 level for the first time as Congress begins crypto week. The other big mover, but to the downside, is oil. NYMEX oil down to $67 a barrel after President Trump did not include direct sanctions on Russian oil exports. And yields are modestly higher across the curve before this week's batch of inflation data.
Absolutely. It's going to be interesting to see how markets perform, not only today, but really for the rest of the week, particularly on the heels of Trump's latest tariff threats over the weekend and ahead of that big inflation report tomorrow. After 4 months of overestimated CPI readings, Tuesday's print could possibly prove to be the first to reflect the true negative impact from shifts in U.S. trade policy.
The base case is that we will see inflation emerge, and we think we'll see some signs of that tomorrow. We think that what you will see in CPI is that there are a bit of uptick in core goods, especially with used cars. We think that you'll see some core services tick up as well. And we think that that'll give the market a bit of pause.
And that report comes just as corporate executives get ready to show how they performed last quarter and tell investors where things might go next. The real question mark, of course, is on trade. Are tariffs simply the ghost in the machine, or are they the machine themselves? Investors seem to think the former, as earnings revision momentum actually turns positive after dropping in the last reporting cycle. But there are big question marks out there, which typically means big volatility, as the lack of consensus heading into each earnings report can drive massive stock price swings once that report arrives. Options implying wider price moves than in recent quarters, and though they won't be quite as extreme as in April, they will come with much greater dispersion in some of those individual names.
And that could be opportunity for a lot of investors. Let's stay with volatility for a moment here, because there's a fascinating divergence in how price swings are showing up. What you're looking at here is a ratio of S&P 500 single stock volatility relative to the VIX, which tracks index level volatility. So when the line goes up, as it did here over the past month, that's a sign that volatility in those individual names is higher than for the S&P 500 itself. At one point at the end of last week, that ratio was the high since going back to February. Now, as we enter earnings season, what materializes all depends on what companies are willing to say about the impact of tariffs, both potential and actual. Romaine?
Amy Wu Silverman joins us right now to kick us off to the close. Equity derivative strategist at RBC Capital Markets. And Amy, I know you always keep an eye on volatility. When you look at the chart Scarlett just had and you look at some of the data that we've had over the past few weeks and months, are we in a position where maybe we're sort of underpricing volatility?
Yeah, it's interesting. So I'll speak to two things. The first is when Scarlett was talking about the single stock volatility relative to the index volatility, so we refer to that as dispersion, or alternately you can think of it as correlation. That really has been just continuing to hit lows. There's some structural reasons why that's true. There's a lot of index volatility selling in the short term from certain ETFs that are harvesting volatility. But as you get into earnings season, I think you're going to see that exacerbation in individual volatility as these names come out and there's idiosyncratic risk.
There's also the issue that anytime you head into the summer here in the United States, obviously a lot of people are away or maybe not as attentive as they would be during normal times of the year. Is that going to exacerbate some of the price swings potentially?
Yeah, I think so. You know, I think about when I started my first day of vacation last year, which happened to be August 5th, you know, Murphy's Law, right? Yes. So if a derivative strategist goes on vacation, the VIX must spike. Mm-hmm. And, you know, we hit a VIX, I think, of in the 60s that day. And it seemed innocuous. If you remember it, it kind of started out with poor data that led to this yen carry unwind. But to me, the most important part was we were sort of in this liquidity vacuum, and we are getting to that month. So while July is seasonally a very good month for returns, a very low month for volatility, August is actually the inverse.
Remember, before you leave, you have to let us know when you're going on vacation this summer so we can make note of that.
I'll keep you noted.
We'll chart it out and make sure that everyone can see it. I got to ask you, though, about tariffs. This idea that the president has been threatening new tariffs 100% on Russian imports, for instance, and, of course, other countries or regions like the EU as well. Investors seem to be dismissing that completely. You look at the price action. Talk a little bit about the taco trade and how that fits in with volatility and people positioning for volatility.
Yeah, I think it's very challenging, and I've been doing a lot of commiseration with investors who are like, look, one, this is going to have an impact regardless of what the tariff rates are, simply because investors and companies are making decisions based on the fact that they don't have the information. And then second, when we finally do get the information, that obviously will have an impact. When you look at the term structure of volatility, so essentially what the future uncertainty is, that has been steeper than normal because that fear, even though it has been can-kicked, hasn't gone away. We've just pushed it kind of further down the road. And there's sort of two camps. There's one camp which is like, look, we're going to get a reckoning. We can't tell you when, but we are going to get a reckoning. And then there's a second camp which just believes we're going to look through that. If I had to choose, I would probably be more in the first camp.
Is that reckoning going to come as early as this week with the CPI and PPI data? As Mark Cabana of Bank of America Merrill Lynch suggested, we might actually get concrete evidence that inflation is percolating?
Perhaps. I don't necessarily think so, but perhaps. And if we do, again, just going back to that liquidity vacuum, I don't think anyone's really positioned from that options-wise. You know, when you look at what the term structure is saying, so where, like, pinpointing where that uncertainty starts to pick up, it's more in the September to December region. Obviously, there's a rates element to that as well. But when you look at what is being priced, it's that we're going to see more of that inflection point later this year.
There's been a lot of talk about the idiosyncratic nature of this market, the idea, you mentioned the dispersion, obviously stock pickers market, pick whatever euphemism you want. How does that change the complexion with regards to hedging? Does hedging also have to become idiosyncratic as well, or can you sort of do that in more of a blanket fashion?
Yeah, well, so one thing is when you think about general hedging, so hedging on the S&P or using VIX, you usually need something to kind of just move everything together. So April 2nd was a great example of just, we all panicked, correlation spiked. There's certainly a chance we get something like that because if you think about the geopolitical risks, if you think about the data points that could happen. And so one thing I've just said is if you're willing to think of it as simply an insurance premium, it is quite low. But when you look at the option pricing around a big name like NVIDIA, for instance, it's not that expensive yet. And again, it is kind of a late reporter, but given the concentration of the market is really geared to like 7 or 8 names, people have been doing a little bit more of this grab bag of let's just kind of do the hedging on an individual basis.
But I was looking at some of the implied one-day moves for post-earnings for some of these names. And if you look at some of those big names like NVIDIA, Microsoft, the moves are actually much smaller than past quarters. I mean, still pretty sizable, talking 6, 7, 8, 9%, but not necessarily the double-digit percentages that we saw even the last couple of quarters. However, when you get down the ladder in market cap, that's when you really start to see much more. And I know that's partly a function of them being smaller, but I wonder if that's also a function that a lot of those names have kind of been left to the side for the last few quarters as people focus on the NVIDIAs, Microsofts, et cetera.
Yeah, I think that's part of it. And if you actually look at the volatility spread, essentially between IWM, so you're kind of like small mid-cap proxy versus S&P, that's actually gotten quite high. And I think part of that is this element of like, are we finally going to get a breadth widening trade? Are we finally going to get small cap stay in the sun? I know Lori Calvasino would love that, but that has had so many fits and starts that have not come to fruition. It feels a little bit like Boy Who Cried Small Cap. So we haven't seen that yet. But I think that's part of the reason you see that volatility differential. Whereas in the big cap names, there's that benchmark FOMO, meaning you have to participate if they start to go up simply because that's your benchmark. And you just don't have that same problem in small caps.
What worries you the most as we head into earnings season?
I think two things. One is X earnings, so meaning an August 5th event that we're just kind of not asleep at the wheel for, so one. But then within earnings, I think if you do start to see companies say things guidance-wise that make people nervous, because a lot of this resilience has I think made people think, okay, it's not going to happen, it's not going to happen. But some investors tell me, like, I just want to go and look at 2026. I just close my eyes and look through this year because it's going to be so messy and so many cross currents. And then so the surprise to me, positioning wise, is if we do get it earlier than people expect, because right now we've just said it's going to be a can-kicking situation, and so we don't need to worry about it.
All right, Amy, always great to have you. Amy Wu Silverman, equity derivatives strategist at RBC Capital Markets, kicking us off to the close here on this Monday afternoon. When we return here on the close, Lisa Nee, managing partner and head of real estate at Eisneramper, to discuss why the big, beautiful bill might usher in one of the most transformative shifts for the commercial real estate market.
From expectations in the real estate market to inflation expectations, a breakdown on what could come out of the CPI report due out tomorrow with Lauren Goodwin, economist and chief market strategist at New York Life Investments.
And we're going to talk about expectations for the bond market going forward. The idea that, well, getting bonds into your portfolio is more than a trade, it's a strategic stabilizer. Sara, Devereux, who leads Vanguard's global fixed income group, going to be joining us in just a bit, right here on The Close, right here on Bloomberg.
Fed Chair Jay Powell once again under scrutiny as President Trump's allies slam the $2.5 billion renovation of the central bank's headquarters. This marks the latest criticism the White House has leveled at the central bank in its crusade for lower interest rates. Let's bring in Stuart Paul, U.S. and Canada economist at Bloomberg Economics. We know President Trump can't replace Jay Powell until his term ends next May, which means he would need to fire him for cause if he wants him gone earlier. How much does it matter if the cause is completely unrelated to monetary policy?
I think by the letter of the law, it doesn't matter whether it's related to the administration of monetary policy. In fact, by the letter of the law, the Federal Reserve should be relatively insulated from the political process when setting monetary policy. It would just be for something like egregious overspending that the president could potentially fire the Fed chairman for cause. But it's pretty clear that this is just red herring. The reality is that the administration wants lower interest rates to extend the economic expansion, and the president has been very clear. He wants lower interest rates to lower financing costs for the Department of the Treasury. All of this discussion about overspending at the Fed is just to create smoke and mirrors, to create the opportunities for those two larger priorities.
So two questions. The first is, if we're talking about the potential for firing Jay Powell, is that firing him as Fed chair or removing him altogether from the Fed? Because he has another position that, in theory, he could camp out in for another couple of years.
I believe, according to the Federal Reserve Act, you can be removed both from the board and from his role as Fed chairman for cause. If this is typical, if you are removed or otherwise not re-upped for your spot as chairman, you typically resign from the Board of Governors as well.
Well, that's what I'm curious about, because this is raising the whole question about true Fed independence and, more importantly, the credibility going forward. If there is this perception that Powell is on the outs, whether he makes it to May or whether he doesn't make it till then, there is now this perception kind of creeping into the markets that whoever replaces him is going to be way more dovish, and the markets are going to adjust to that as soon as they have some certainty about it.
That's right. And it would be an extremely myopic decision for the president to fire the Fed chairman, remove the political autonomy of our monetary policy making institution. You would see something like the dollar selling off 3, 4, 5% immediately upon the removal of the Fed chairman. You would see longer term yields, the 10-year yield, again, testing 5%, because investors would be skeptical of any new politically motivated, dovish Fed chairman who would be put in place basically to monetize the national debt. They would need to bake in some additional inflation compensation into their interest rates, into what they're expecting from the bond market.
So the White House is clearly dropping crumbs and laying the groundwork for doing what it wants to do. How quickly could this all materialize if the president moves forward with finding a way to get rid of Jay Powell?
I think it would be rather slow, actually, because you could see, look, President Trump can be very decisive and move very quickly. You could see an announcement as soon as this afternoon on Truth Social making me look very foolish, but I'm sure you would see a lawsuit and some sort of an appeal, which could end up coming with a motion for stay, so that the Fed chairman potentially could stay in place pending a court decision to see whether the president does have legitimate grounds for moving him. So all told, it could last quite a long time.
This is just remarkable you've been having this conversation, at least in this country. I mean, I know there are other countries this is kind of standard practice, but not here. It also raises a big question, too, about the idea that some of the people contending, potentially being contenders for this job, are also the same people that are publicly criticizing Jay Powell out there right now, which also seems odd to me that we could end up with the Fed chair that maybe potentially facilitated Jay Powell's removal.
That's right. So within the administration, you have people like Kevin Hassett who have been very critical. He was critical on the Sunday shows, very critical of the Chairman Powell. If he were to move into the chairman's role, you could see him effectively rejected or sidelined, or, as Neil Dutta said, made chairman in name only, as the rest of the members of the Board of Governors and the regional Fed presidents basically stand their ground against someone from the administration moving in to replace Chairman Powell. If you were to see someone promoted from within who has a lot of institutional credibility, somebody like Chris Waller, then you could see a little bit less of that political tinge assigned to him, and you could really see a more dovish Fed chairman and a board coalescing around him.
All right, Stuart Paul, who are all over this for us at Bloomberg Economics, our U.S. and Canadian economists. We'll be back in a moment. This is The Close on Bloomberg. Time now for our top calls. Big movers on the back of analyst recommendations, and we start off with Rivian. Guggenheim downgrading to neutral from buy after negative changes to U.S. electric vehicle and emissions policy. The analysts saying the headwinds presented by those changing government incentives presents both near and medium-term challenges, including downward pressure on sales and sales prices. Those shares down 2.5% on the day. Next up, Stitch Fix. William Blair fixing up its rating to outperform. The upgrade coming on the analyst's confidence with the personal styling company's CEO and that he has found a strategy that will promote client growth into 2026. Those shares up 10% on the day, though we should point out a fraction of where they were just a few years ago. And finally, Goldman Sachs. Citizens JMP downgrading the bank to market perform. The firm also downgrading KKR, Evercore, SoFi, saying that after the tremendous moves higher in those stocks over the last few months, we just want to be a bit more selective in our highest conviction names heading into earnings seasons. You see those shares up on the day ahead of those earnings, which is ostensibly kick off tomorrow with JP Morgan, BlackRock, Wells Fargo, Citi, and quite a few others set to report, kicking off the latest round of big bank earnings. Devin Ryan joining us right now, Director of Financial Technology Research at Citizens JMP. And Devin, you're heading into this earnings season relatively bullish on a lot of those names, right?
Hey, Romaine, we are. So you go back 3 months ago, and obviously there was a lot of uncertainty in the tariff conversation, and stocks were really beat up pretty good. And so we were telling investors to lean in at that point, even though uncertainty was high. And now, 3 months later, Goldman Sachs stocks up over 60% from the lows. Evercore, we upgraded it 3 months ago, stocks up 80%. So we're just saying, let's be a little bit more selective here. We think earnings season will be good, and actually, business trends are getting better, but it's just a little bit of a dynamic between where valuations are relative to business. And so we just want to be a little bit more selective right now.
What do you see, or I guess more importantly, what do you want to hear from some of these executives on the conference call about the next couple of quarters? Because to date, at least when you talk about the big money center banks, we talk about trading revenues doing well. I know the investment banking revenue may lag, but we've seen a pickup in activity in the deal space over the last few months. What gives you a little bit more hope for the next few quarters, given all the things that battled around these stocks to start the year?
Yeah, so 3 months ago, companies weren't able to really give any outlook, and I think that was the challenge at the time, that there was such uncertainty. So I think investors are just looking for a little bit of clarity and forward-looking guidance. And so, just the past few months, you've seen a really nice reacceleration in M&A activity. IPO activity is picking up. The amount of U.S. IPOs that are priced in the first half of this year are up 80% over the first half of last year. So I think, a continuation of that trend. Last quarter, the question was, is this a pause or a break? And a lot of companies thought it was a pause, but I think we want to hear confirmation that they feel that way. And then, trading is a business that can kind of ebb and flow, but the trading backdrops remain really healthy. So I think people want to see that business can continue to be healthy even as capital markets are recovering and M&A is normalizing and equity capital markets are normalizing. So I think those are a couple of the key things. And the good news is, equity valuations have kind of fully round tripped here. So any businesses, asset management, wealth management will benefit from that as well.
So you downgraded Goldman Sachs, you downgraded KKR, Evercore, and SoFi. Who are you most bullish on? What are the best ideas out there?
Yeah, so we're just recalibrating here a little bit, but we really like Coinbase, which is on the digital asset side. I think that even after the big run there's a lot to come in the back half of this year, just so we get more clarity on legislation. So we would look there. A company that just came public, eToro, is a company that we would look at here, very similar to Robinhood in terms of exposures, but trading at less than half the valuation. So looking to be a little bit selective there. And then there's some small cap names too. So Perella Weinberg's an advisory boutique that we think can do about $2 of normalized earnings, and the peers are now trading about 20 times. So that would imply share price upside of about $40, and the stock's at $20 today. So I still think there's some opportunities here, but some of the names we've liked the most have really run, which is great. And again, we were leaning in April, and we're just right now getting a little bit more selective on some of these other names.
Right, it makes sense. I just look at the KBW Bank Index and how it's returned 32% over the past 3 months, double what the S&P 500 has returned. What is not priced into these stocks then?
Well, I still think that for a lot of these names, the capital markets recovery could be better. So, the good news is that we are rebounding in M&A and equity issuance. But the thing that a lot of times people don't calibrate for is the fact that business footprints continue to grow. So a lot of these firms have added senior bankers over the last 3 or 4 years since the prior cycle peak. So I think that's not fully priced in. And then there's still, I would say, at the large bank side, consolidation of market share. So. Firms like Goldman Sachs and Morgan Stanley, we're still pretty constructive around their ability to take market share. So, again, valuations are getting pretty full. I think you want to be selective here in names that maybe haven't run quite as much, or investors, it's really idiosyncratic stories company by company. Yeah. But it's still a really good outlook as we look into the second half of this year. Just real quickly, only about a minute left. I know those are idiosyncratic stories, but broadly across the industry, there has been some optimism with regards to regulation, in a certain extent, the lack of it, and in the case of crypto, maybe some sort of guardrails put in place here. How much of a tailwind do you think policies coming out of Washington right now will be for the financial sector writ large? Yeah, I think it's a great point. I think it's going to be a big tailwind and also going to help drive valuation. So on a couple of factors, one, just less regulation for banks, I think is supported, but then also just allowing banks to consolidate. We've been in an environment the last at least 4 years where there's been very little bank consolidation. So I think that's going to be constructive for the group, and so we're bullish there. And then crypto, we're essentially transitioning from a market that's been purely speculation or primarily speculation to one where you have real utility, stable coins, tokenization, huge themes that are just getting started. So we're still very bullish on that. Good stuff. Devin Ryan, Director of Financial Technology Research at Citizens JMP. Coming up, we're going to talk about commercial real estate with Lisa Nee of Eisneramper. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston.
And I'm Scarlett Fu. When I went away for vacation,
yeah,
it was
been
still
gone for a while.
Just a week and a half.
You went to like a metal concert or something?
I did not go, but I went with someone who did go to
most of our
Black
viewers
Sabbath
don't know
concert.
that you're a metalhead. just lean into it, Scarlett.
Pictures on my social media account. In any case, I went away and it was one big beautiful bill. I come back, it's law, but we still call it one big beautiful bill. I mean, this is a marketing success for the White House.
It certainly is, even though officially it wasn't called the one big beautiful bill because the Democrats changed it at the last minute. But it gets to this idea, now people want to start to see the implementation of it and the potential upside benefits. We focus so much on the negative aspects of the bill, and maybe that comes to fruition at some point. But in the short term, I think a lot of people are looking at some of the tax breaks, some of the other incentives that are in this bill, some of the changes in accounting policies and regulations that could potentially be beneficial to investors.
Yeah, and a lot of those that you just mentioned definitely affect commercial real estate, which is pretty much President Trump's one true area of expertise, or his original area of expertise, right? An area that he holds very closely to his heart. So
he owns a couple of buildings.
I heard. Yeah. So I heard. All right, our next guest says that the new tax policies are set to redefine investor strategies and property valuations across both residential and commercial markets. And that guest joins us now. She is Lisa Nee, managing partner and head of real estate at Eisneramper. Great to see you.
Thank you for having me here today.
So some people say that this law is really positive for commercial real estate because of what it does contain. And we talked about some of those macro things like permanent extension of tax cuts, which definitely helps drive demand, or the bonus depreciation for manufacturing facilities, which is in line with the White House's goal to reshore manufacturing. But talk about the specific things that you, as someone in the industry, is really looking at as a tailwind.
Yeah, thank you. So again, for commercial real estate fared pretty well within this bill, and there's a lot of provisions in there that, if used appropriately, should spur economic growth for some much needed multifamily housing. We do have a housing shortage here. And so looking at this and sort of just level setting where we are, deals still have to make sense and they have to math out. And so with market rate real estate, deals aren't making sense and the math doesn't work right now. The rents are still flat or minorly up, and insurance rates are up. Interest rates are up and construction costs are up. So other types of programming needs to happen to spur economic growth. And one of those areas that did fare well is low-income housing or affordable housing. Now, with that, the federal and the state governments always have to work together. And so these provisions were put in by the federal government, which are to enhance and helpfully give more low-income housing developers the accessibility to get these credits. The state actually is the one that affords the credits and awards them. And so we work together with a lot of our affordable housing clients to get them those credits, make sure the math works out, to spur that economic development, because that's the way that's going to solve the 4 to 5 million, I think it is, of housing shortage. The low income should be about 1 to 2 million of housings that come on the market in the next 10 or so years. But some of those provisions are really important, and that should spur some growth with the affordable housing. Market rate, again, still has to math out.
I like that phrase, math out. So it sounds like the states have a lot of say, a lot of control here. Do they have the talent to execute on that?
That's a hard question to answer, especially in today's political environment. But it's really making sure that you're educating and you're working with a team who does understand the state and does understand what they're looking for when you're presenting your package, whether it's for qualified opportunity zones or even for low-income housing and even market rate, really working together with the states and the local governments to make sure that they get rid of that NIMBYism fear that everybody talks about, and really creating, not to give New York, but the city of yes, and making sure that there is some spur and giving the developers those credits and incentives they need. Developers want to make money.
Yeah. Did you call New York the city of yes?
Well, that's the new city of yes, is the economic development.
Because I was about to say, a lot of real estate developers will say it's just
no, so that was a program called the City of Yes. We do have something on it.
I do remember that. I am curious, though. I mean, outside of New York City, there has been, and particularly when you talk about the need for more housing and more building of housing, you've seen a lot of cities embrace, whether it's opportunity zones or things similar to that. I'm thinking like Cleveland, I'm thinking Gary, Indiana, a lot of places in the Midwest as well. As you start to see some of those cities sort of vie for these types of programs, do you expect to see a little bit more of a broadening of where real estate investors and builders are looking?
Yeah, right now the Sun Belt is probably the hottest area because that's where the jobs are and where people want to work, and it's the most affordable. When you look at the cities and you look to see why were some of those cities able to spur economic growth, you're looking at the local governments who are able to work with the federal provisions and incentivize and enhance those and make it for the developers who want to be there and build. And that's really why the success of those cities turned around, is because of those local governments working within the creation of what the federal government created, those provisions.
Is there any worry, though, right now, given, I guess, how should we put this, somewhat of a contentious relationship between the federal government and certain local municipalities, that we won't have as much cooperation in certain cities and states on these issues that would actually lead to the benefits coming out of this bill?
Good question.
I mean, that's a great question, and there always is. There's always needs to be balancing and bipartisan. So qualified opportunity zones is a perfect example of bipartisan support. Everybody wants underdeveloped communities to be able to develop. And so qualified opportunity zones, where the governors designate designate those zones, and they can do so every 10 years. That is something that's had bipartisan support in the first round, and now they've made it permanent into the tax code for starting in 2027. So that's an example of people working together for that creation.
Some people say that the law is positive for commercial real estate in that it doesn't include certain things, certain negative things. It leaves certain things out, like no new cap on deferred gains. Talk a little bit about the exclusion of certain things that might have harmed the industry.
Right, so 1031 is still for commercial real estate, which is nice, and what that does is it brings capital back into the economy. So it brings people back in who are willing to trade unloved or properties that need more capital back in. So allowing 1031 to be able to stay within the tax code has been very beneficial. Bonus depreciation, another thing, being able to expense, and again, that's for anything created after January 20th, 2025 is the date, I'm pretty sure. But again, it's getting money back into the economy and getting money back into there to create value. And all those were capital market on purpose. They want to make sure that people are spending and creating those developed communities where people are going to want to live and they're going to want to work. And so those provisions were very intentional as to why they were important and why they were able to stay in the code and have the sunsetting be permanent.
Give us a timeline in which you see things playing out here, because the law just passed, and it's going to take some time, as we mentioned, for the companies, the developers themselves, to get in touch with the states and work through everything. Are we talking about a 6-month or 1-year kind of time frame?
Oh, so any new construction that could even go into the ground won't even be online until 2030. When you think about it, by the time it gets through zoning and it gets through construction and goes online, so it's a long time frame to be able to say that we're going to have make it a dent, even if we do make a dent in the housing shortage here. So this is a very, very long-term commitment to the developers, and that's why it's really so important that people are working together, because it's not something that we can just put up a new building overnight. A lot of the projects are really acquisitions, so they're taking and trading older properties, putting money back into it. So when people are worried about the Class A properties, those Class A properties actually have trickle-down effects. So if you're taking an existing building and you're making that Class A amenities, the next ones are going to be able to serve the B, the C, the D. So any capital infusion you have in commercial real estate is always good. It's always going to be for the betterment of a community.
All right, Lisa, this is great. Really smart stuff. Lisa Nee is managing partner and head of real estate at Eisneramper as we continue to count you down to the closing bell. Stocks in a bit of a standstill, though green arrows for most of the major indices. But the biggest arrow today probably has to be on Bitcoin, a rally above $123,000 at one point on the day, and that's boosting the shares of several of the stocks in the crypto sphere, including Strategy, as Crypto Week, Scarlett, kicks off in Congress.
Remember Infrastructure Week? Now it's Crypto Week.
There are actually 3 real bills attached to this, unlike Infrastructure Week. We'll be back in a moment. This is The Close on Bloomberg. Time now for our Stock of the Hour, and we're taking a closer look at Strategy at its highest level since late November, getting a big boost from, well, the big boost in Bitcoin, a blistering rally that took the cryptocurrency above 120,000 earlier today. And it comes during a week where Congress is set to kick off potentially votes on 3 key pieces of legislation: the Clarity Act, the Genius Act, and another act that would, well, restrict the Fed from getting in to the crypto sphere. Stacy-Marie Ishmael joins us right now, executive editor for us at Bloomberg, covering all things crypto. All right, Stacy, I guess this could be a phenomenal week for crypto should these bills pass, at least 2 of them pass. And, with Bitcoin at an all-time high, it's just Goldilocks right now for the crypto industry?
That's definitely the narrative. Yeah. I think, to your point about the big, beautiful bill, when you have something named that has momentum around it, it's really driving sentiment. The big thing that people are looking for is what's going to happen with the stablecoin legislation. There is bipartisan support for that one. You still have some Democrats criticizing it, but if anything happens in crypto, people are expecting to end this week with, the president signing legislation affecting how stablecoins are regulated in the United States.
Okay, so that one is more likely to go through than the others. Do the other 2 bills have bipartisan support?
The other big one is what's called the Clarity Act, and it's so called because it would provide some specificity over what is the jurisdiction of the U.S. Securities and Exchange Commission and what is the jurisdiction of the CFTC, which have been the 2 regulators that have both sort of shared oversight of digital assets, but not in a way that the industry has found clear or satisfactory. The third one is a little bit weird. It's a move to forbid the United States from ever issuing the equivalent of a digital dollar, what's called a central bank-backed digital currency. I think folks are like, if that one moves, fine, but they really want to see momentum on the Stablecoin Act, and they really want to see what happens with clarity.
Outside of these pieces of legislation, there's also been a lot of optimism just in general, maybe primarily because the president or at least his cohort seem to be big supporters of the crypto industry writ large. Is the optimism that we're seeing right now, I guess, is it warranted? And more importantly, do you think it's going to continue?
The way that we look at the optimism is obviously, you have all these charts of the strategy share price. You see like the Bitcoin price hitting record after record. Institutional investors seem to have decided that if they're going to be not left out of at least one part of this rally, they need to be getting in on Bitcoin. And, that's like the classic wall of money in the United States, right? When you have the Vanguards of the world and the other asset managers saying, okay, like, strategy is going to be in our index fund. Coinbase is going to be in our index fund as a crypto exchange that recently entered the S&P 500. And we're seeing a little bit of a shift in the way that even like the retail investors are playing this. Like more of them have access to ETFs in their 401ks, but they're also going to, shall we say, the riskier parts of the market. So things like meme coins, alternative coins of that nature. So it's a very broad-based rally. There have been other times when it's like, oh, it's only in this section, or you're only seeing movement in the top 5 tokens, and really we're seeing movement like up and down, like the value proposition.
Yeah, it's even lifting Ether, which for a while was kind of lagging behind Bitcoin the also ran, yeah, but it's getting a boost at least today, and some smaller coins as well. Stacy-Marie Ishmael, thank you so much. Executive editor over at Bloomberg Editorial. And of course, Vanguard is actually the biggest single shareholder of strategy now through index funds and mutual funds, ironically.
The biggest holder of a lot of stuff. But it gets to this idea that you can't really avoid it, right? I mean, even if you have an ideological opposition
like
to
Vanguard.
At the end of the day, it is becoming, if not the 800-pound gorilla, certainly like maybe the 200-pound gorilla.
Yeah, it's inevitable in any case.
Is that an analogy?
Coming up, we're going to take you to the closing bell with Nadia, Lovell, senior U.S. equity strategist with UBS Global Wealth Management. This is The Close.
There's sort of two camps. There's one camp which is like, look, we're going to get a reckoning. We can't tell you when, but we are going to get a reckoning. And then there's a second camp which just believes we're going to look through that. If I had to choose, I would probably be more in the first camp.
Amy Wu Silverman kicking us off to the close just about 50 minutes ago, looking ahead into this earnings season and the expectations that the market is priced in.
Yeah, well, right now, people are pretty happy with where things stand. The NASDAQ 100 at one point was at a record high. It has pulled back a little bit here, but still up by 0.3%. We see small caps continuing to outperform the big caps. That's really been the trend over the past 1 month, with the Russell up 0.5%. Energy stocks, though, are the weak link today. Yeah, energy stocks are the weak link. Actually, some of the tech stocks, believe it or not, I was surprised that some of them are relative laggards, I should say. I mean, most of them are kind of unchanged on the day. But it gets to this idea that when people are looking to enter or chase this rally, if you will, they're not necessarily chasing the big cap stocks that took us here. They are looking maybe at the mid caps, even the small caps, basically some of the stocks that have been left behind. Yeah, financials have been cited by a lot of people, especially as they've already seen big gains, but especially if you go lower down the size. Yeah, and of course, they're going to have to start showing improving tomorrow as we start to get our earnings out of those names, at least the big banks. Nadia Lovell joins us right now, senior U.S. equity strategist with UBS Global Wealth Management. All right, Nadia, heading into this earnings season, I think a lot of people are looking at the earnings expectations, which if you go by Bloomberg estimates, are very low. You don't necessarily think, though, that that bar is as low as maybe it looks.
I agree with that, because when you think about it, like, yes, from an earnings growth standpoint, the bar is low. 4% consensus is looking for. That's a huge deceleration from the first quarter when we had sort of low teens EPS growth. And much of that has to do with the fact that consensus isn't looking for as much year-over-year margin expansion. But when you think about it from a stock reaction standpoint, the bar is probably high because we've had such a strong rally so far. So there's little room for error here. We do think that companies are likely to beat. We're already seeing that in some of the early reporters beating by about 4%. But again, the stock reactions are likely to be muted. I think where you could see is that those that miss are likely going to be punished a lot more, because what's going to happen is that the market is looking for confirmation of that growth narrative. And anything that flies in the face of that is probably going to spark some profit taking. And so I think that's what we have to look out for this earnings season.
So it's interesting you say that because we haven't really gotten any earnings. We got two last week, one from Delta, one from Levi, that surprised to the upside. And we did see some pretty meaningful reactions. But now we're starting to get to some companies with the financials and obviously with big tech that are either at record highs or very close to them. So if those companies don't beat meaningfully, you don't think we'll see a meaningful increase in the share price?
Don't think so. I mean, financials, we are actually pretty positive on. We upgraded financials last month to an attractive. So we do expect financials to beat expectations this quarter with the major banks reporting starting tomorrow. And when you think about it from a trading standpoint, trading revenue should be strong. We had a volatile second quarter. Markets are at all-time highs. Capital market activity improving. Still a lot of room to go. We're starting to see M&A activity pick up as well. But I think, looking beyond just the earnings season for banks in particular and financials in particular, our thesis there is really about deregulation, which is seeing that accelerate. The Fed has already put out a proposal for, decrease of the SLR that could free up balance sheet capacity. And then we had, stress tests and things like that. So I do think that there is legs to the story in financials. Even if you see a bit of a pullback in the quarter, we'll be buying that. And tech as well. Tech record highs, off of that April low. You could see some wobble and some profit taken. But again, we're starting to look at tech through the secular lens and also the longer term. So again, if you see any weaknesses of that, we will be buyers of that.
How much of a driver do you think share buybacks will be this earnings season, especially with prices near highs?
Not so much. I mean, what we're sort of looking for from banks in general is, the continued story in terms of the capital returns, whether that's dividends or share buybacks. I think the market will be less focused on that this quarter. And what the market really wants to understand is the outlook for a lot of these companies. There's still so much uncertainty around tariffs and why we're not seeing tariffs come through yet. In the macro data or the inflation data, reality is what? $27 billion was collected from customs by customs in June. Somebody has got to eat that at some point.
I'm glad you bring up the forecast because Wu Silverman was telling us about how investors just want to get past 2025 because no one knows what's going to happen. There's so much uncertainty and they want to get to 2026. How much faith does anyone have in the 2026 estimates, though?
I would say people probably have more faith in the 2026 estimates and sort of second half estimates. And the feeling is, and you might say, why? That seems so far away. But the feeling is that while we're seeing this sort of escalation again in tariffs tension, I think the market is still looking for things to potentially escalate temporarily and still come back down. So our core view is by the end of the year, the effective tariff rate is still going to be around 15%. That's not to say you're not going to see some fluctuation between now and then. And so we think that the environment will be more clarity in 2025 and less uncertainty. The Fed is going to be cutting. And so we have a bit more conviction in what things look like in 2026, which thinks this market will be higher.
I do want to go back to something you just said about this idea of the amount of tariffs that have been collected in this country. You mentioned the $27 billion. I think overall the government says, 113 billion collected in the first half of the year. That has not shown up, and I am wondering where it is. I mean, that's real money.
Yes.
It's coming out of someone's pocket, not the country's, most likely something domestically. And if we're already at, 6 to 9% effective tariff rate, which is like triple where we were at the start of the year, and we go to 15, why am I not seeing that show up on corporate income statements or in inflation reports, et cetera, et cetera?
I think it takes time to come through the system. And reality is that because of the uncertainty, tariffs is on one day, off the next day. I think companies are also hesitant to pass along that to consumers. We don't expect to see it in CPI tomorrow. We think it's going to take a couple of months because, this is not the 2018 trade war. Consumers are more sensitive to price increases. And so companies are in this wait and see mode. But we think eventually when you factor in that 15% tariff rate, you're probably going to see about 100 basis points increase in CPI because, those consumer discretionary companies, retailers and so forth, they cannot eat all of this. They have thin margins.
Yeah, and I'm curious, just real quickly, when you look around at the various sectors, are there sectors out there that you look at that you think are going to be, if not insulated from the tariff trade issues, will at least somewhat have some degree of a buffer from any negative impact?
I think when you think about it, like it goes back to tech. Yes, we have sectorial tariffs still to come, still uncertainty around semis. But again, you have to look at things about what do things look like for those industries in a year, in 2 years, in 5 years. And we think that the AI spending is not going to stop, Like there's pricing power, what you might pay for a computer at the consumer level versus what, an enterprise is going to pay for an AI server is not going to change.
All right, Nadia, you got to leave it there. Great stuff. Nadia Lovell, Senior U.S. Equity Strategist at UBS Global Wealth Management, counting us down to the closing bell. Scarlett, 2.5 minutes until we get there. Stocks holding right around where they were at the start of the show.
I was just taking a look to see which parts of the market have performed the best since April 8th, that low that we hit. All 11 sectors are higher, but tech and industrials have really been a big story over this past couple months.
And the industrial story is one that I think could actually be probably the more interesting story this earnings season, should they actually show improve. A full breakdown of all of today's market action and a look ahead to tomorrow with our global simulcast right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, taking you through to the closing bell with a global simulcast. It starts now. Tim Stenovic joining us from the radio booth. Nora Melinda in today for Carol Masser. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube, Tim Stenovic. Green across the screen for most of the major indices, but of course, we have two big catalysts coming up on the calendar within the next 24 hours.
I think you would be referring to CPI and then the kickoff of big bank earnings tomorrow. Is that right?
That is correct.
Okay.
Sir.
Looks like we're reading the same stuff, Romaine Bostick.
Yeah.
That's always good news when we're on the same page. Hey, there's also the trade element here, and I think that's what people thought and certainly kind of did dominate today's trade, even though we didn't see a big variation between gains and losses. The comments about President Trump kind of saying, okay, maybe not 30% for Europe, we're open to negotiating, given what happened over the weekend, might have given a little bit of a relief to investors out there today.
I mean, definitely some relief that we are seeing here with all indexes ending in the green. As we were saying earlier, if you went to sleep on New Year's Day and you woke up today, lots happened in between. But if you look at the S&P 500, not much has changed.
Yeah, I go to Tim's point about, the trade tariffs and the threatened tariffs not showing up in the price action, but showing up in activity, because volume is certainly down compared to the 30-day average.
Yeah, and we should point out, of course, I think the earnings picture is really going to be one that drives this market, not so much for the second quarter results, but obviously the commentary that a lot of CEOs and CFOs were unwilling to give the last go round. This time around, they might not have as much coverage. Green across the screen here on this Monday afternoon for most of the major indices. The Dow Jones Industrial Average looking like it's going to close out the day higher by more than 80 points, or about 0.2%. The S&P up just about 10 points on the day. We'll call it about 0.1% as we wait for these numbers to settle. The NASDAQ Composite adding about 0.3%. And the Russell 2000, that's your outperformer on the day, again, up 15 points, or about 0.7%.
All right, taking a look at how things split up in terms of gainers and decliners today. We did see more stocks move higher in the S&P, 286 to the upside, Scarlett 213 to the downside.
And that's reflected in the IMAP as well. So take a look at the 11 sectors in the S&P 500. That big red slice that you see there is tech, but it's only down by 0.2%. The leading decliners here are energy stocks as oil prices sink, and material stocks also lower by 0.4%. Best performers, communication services, financials before the banks report earnings tomorrow, and real estate investment trust.
All right, on the gainers side, a new all-time high for Fastenal. The company reported earnings earlier today. Shares 4% higher at the close. The company reported net sales for the second quarter that were up 8.6% over the same period last year. It did meet the average analyst estimate. We had Dan Florness on the show, the company's CEO. He said that his industrial customers are starting to see business turn around. Here's what he said, quote, "The knife has stopped dropping." What he was referring to is the trying to catch a falling knife over the last few years that really in the U.S. has been industrial production. I did ask him, and Nora asked him too, about the impact of tariffs. And he said they tried to move their supply chain back in 2018 during this first round, and they were able to make some changes, not necessarily bringing anything back to the U.S., just not possible right now. Too early to say for his customers, though, whether this new tariff regime will prompt them to move manufacturing back to the U.S.
It's just a reminder of how long it takes to actually move your supply chain back to the U.S. If they were talking about this back in 2017 and weren't able to get very far.
Yeah, I mean, do you remember the move back in 2017 and 2018 was to move everything out of China and like go to Vietnam or Indonesia or India? Well, now it kind of doesn't matter where you are if you're not in the United States, because all of those countries are getting tariffed as well. Hey, did any of you guys see Superman over the weekend?
No. Was it good?
I didn't see it either. A lot of people did see it,
We
though.
look at you when we see Superman.
I was going to say.
Wow. Oh, you guys are the best. Warner Brothers Discovery shares up more than 2%. This after the company did say that they brought in at least $115 million domestically. It did take in $220 million worldwide. This according to a statement from Warner Brothers. $125 million in ticket sales in the U.S. So that did beat expectations of $115 million. This is just the opening chapter in a 10-year plan to interweave movies and TV shows based on DC comic book characters such as Batman and Wonder Woman. Haven't they done this before?
Yeah.
Okay. All right. I'm just.
They've done this. And so, I mean, I don't know. Do you think DC is going to get it right this time? I mean, everyone's saying, okay, you had a decent box office domestically. Though don't look at the international numbers, Tim. Was not as good. But this idea that maybe they could finally build off this and actually truly build up something that's comparable to the Marvel universe.
Look, I don't know what it takes to have a successful franchise. No
I don't
question.
either, but I like the opinion.
But we can look and see what the Marvel universe has done, right?
The peanut gallery speaks.
Yeah, exactly. I think James Gunn knows a little more than we do when it comes to what makes a successful movie. And finally, I do want to talk about shares of Kenvue real quick. They finished the day higher today by more than 2%. It's the company behind Tylenol, Neutrogena, Listerine, formerly the consumer healthcare division of J&J. The company said that CEO Thibaut Mongon is going to leave the company as it continues to revamp. The board director, Kirk Perry, will take over as interim CEO effective immediately. They faced push from activist investors for changes on how the company is structured and run ever since it was spun off from J&J just a couple of years ago. Once again, Kenvue shares up by more than 2.2%, Nora.
Well, a couple decliners that I'm keeping an eye on right now. We had Waters, that is a life sciences company, about $18 billion in market cap. It fell for double-digit losses when we ended at the close today after saying that it'll merge with Becton Dickinson's biosciences and diagnostic solutions business in a reverse Morris Trust transaction. That's valued at about $17.5 billion. We had Jefferies analysts saying that they expect the stock to trade down due to the deal size and variables added to a clean replacement cycle story. But if you look at the stock on a year-to-date basis, down about 18%. I know it's Monday, but I did want to talk about an alcohol company. I'm looking at Constellation Brands, and we're seeing shares that also fell at the close today after President Trump declared a 30% tariff for Mexico and the EU, which, of course, we know these are key markets for those drink makers. So tariffs are really the story here. But this is a $28 billion company. They own Modelo, Corona, a lot of the names that we know here. But shares are down about 26% this year. So not great news here for the brand. Maybe people are going to healthier alternatives. We'll see.
I like the fact you picked an alcohol company because you really, truly are filling Carol Masters.
Have to live up to it the best I can. Also, Fluence Energy, that's an energy this is an energy company, and we saw energy is the worst performing sector in the S&P 500 today, and this was one of the names that was in the red. Mizuho cut the stock to neutral from outperform. They're also pointing toward this tariff impact, and additionally, the Republican tax and spending bills effects on the clean energy sector. The company is about $1.4 billion in market cap, but I'm looking at the year to date as well, down 50%. Not looking good.
All right, let's get a quick check on yields. Continue to see a steepening of the curve. Treasuries overall falling for a third straight day. That's pushing yields higher. But two interesting dynamics are playing out. One is obviously that you're seeing much greater moves in yields on the longer end of the curve to the upside. But on the short end of the curve, take a look at that. A 1 basis point move, 1.5 if you want to be particular, on that 2-year yield. And that has been the narrow range that we've actually seen on the shorter end of the curve now for quite some time. In fact, the past 3 sessions, we basically had 1 basis point, 1 basis point, and then 3 basis points. And then if you keep going out, it really doesn't get much wider than that. And I think it is kind of telling, Tim and Nora, this idea that maybe you have a market, at least in the Treasury market, with a lot of folks right now on the sidelines.
Okay, well, we'll see what happens when it comes to CPI. We'll see what happens when it comes to the big banks reporting earnings. In the meantime, I want to talk a little bit about return to office. Yeah, we're still talking about that. It's back in the news this week because Starbucks employees who work at corporate headquarters are apparently going to be required to come in 4 days a week. This is a focus. Excuse me?
Which 4?
I don't know.
Maybe they get to select the day that they stay home.
Well, I know that there are some places where they're like, okay, everybody has to come in at least on like Monday, because that's like our in-office day. And it kind of looks like not a lot of people go to work on Friday, just anecdotally speaking, at least here in New York.
Understandably
judging by the
so.
subway, I don't know.
Well, we're all here, right? We're in person, but I think this is really interesting for Starbucks. I mean, I was just at Starbucks yesterday, and I had a nice refresher. I don't know if you guys have had the refreshers, but fantastic. And we're really seeing, Starbucks really just trying to do better. They're trying to have a turnaround story here. So I guess they need people in the office to do it.
Well, it starts with the culture, according to Brian Niccol, who's the CEO of Starbucks. We're keeping an eye, of course, on the tariff story. And even though there's new threats of tariffs and companies still aren't able to say very much, there is evidence that it is affecting certain industries. The world's largest swimming pool maker says they will likely hike prices for a second time this year because of Trump's proposed tariffs. This is a Spanish company, Fluidra, talking about this. And they said how much they can't say right now. It really depends on what gets announced about China in the coming weeks.
Yeah, and this is kind of what I'm really interested in for this particular earnings season. The idea is whether we're going to hear more companies, certainly more U.S. companies, start to talk about the potential impact. We just had Nadia Lovell on the TV program a little while ago, and she was kind of alluding to this idea that we've collected in this country more than $100 billion in tariff revenue. But of course, we know that comes out of someone's pocket. Mm-hmm. And at least for right now, we have not actually seen that show up in some of these income statements or in some of the inflation data, and I do wonder if that's about to change.
And that's why the guidance tomorrow and throughout the rest of earnings season is going to be so important, the commentary that we hear. Although, is there more clarity? That's, about what the actual policies are.
At some point, company executives just need to say how they're moving forward, even if they don't have the clarity, right?
Yeah.
Absolutely.
Okay, we'll
how
wait
big
to that.
How big of a swimming pool do you have, Scarlett?
Mine is massive.
All right, party at Scarlett's this weekend. Thanks for the invite.
I'm going.
Looking forward to it. That is going to do it for our cross-platform coverage of the market close on Bloomberg TV, radio, YouTube, and Bloomberg Originals. We will see you back tomorrow, same time, same place. Scarlett, welcome back.
And our coverage continues here on Bloomberg Television, a preview of tomorrow's big CPI report here in the U.S. with Lauren Goodwin of New York Life Investments. Stick with us at the close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
Markets closed up shop just about 11 minutes ago, and you can see on the screen behind me the price action was somewhat subdued. Not quite risk on, but certainly not risk off either, with the S&P still moving higher by about 0.1%. The Nasdaq 100 on an intraday basis trading at a record high. And of course, all the talk today was about Bitcoin. At one point on the day, breaching $123,000, a record for the lead crypto out there, falling back just a little bit below that here, but nevertheless, you're seeing a lot of enthusiasm in that space, particularly as Congress gets set to vote on 3 consequential bills for the industry. Meanwhile, for the rest of the equity space, there is a big focus right now on earnings and, more importantly, on tariffs and how they tie into that. Meta Platforms moving higher on the day. So were a lot of the bank stocks, including Wells Fargo, which reports tomorrow, along with Citigroup, JP Morgan, as well as BNY Mellon. But also keep an eye on the tariff situation. You see that reflected here in two assets. One is on orange juice futures, up about 9% on the day, and that's largely because of the tariffs threatened on Brazil. Then you have Constellation Brands, down about 4.5% on the day, and that's largely, because of the tariffs threatened on Mexico. Constellation Brands, of course, a big beer seller, and of course, it has huge outsized exposure to the market in Mexico. And that brings us to our top story of the day: trade, inflation, and earnings. With punishing tariffs theoretically kicking off in less than 3 weeks from now, traders are bracing for what would be the weakest earnings season in 2 years. Any sign that tariff-related price pressures built up last quarter, and more importantly, any sign that those price pressures would become entrenched, that would risk corporate margins and raise further economic concern. But is that concern misplaced? There is scant evidence so far of material demand destruction or material inflation related to tariffs. So little that analyst earnings revision momentum has turned positive after dropping in the last reporting cycle around Liberation Day. And many of the themes driving markets to record highs, like AI, are much more structural. Even Bloomberg Economics expects another soft CPI report in the morning with only modest tariff pass-through in the goods categories. Lauren Goodwin joins us right now to sort it all out. She thinks tomorrow's CPI report is less about what's happening now and more about whether the disinflation we saw in the months past was indeed Real. Lauren Goodwin, economist, and of course, chief market strategist, New York Life Investments. Great to see you, Lauren.
Good to see you, Romaine.
So kind of explain this. I mean, when we talk about this idea of an inflation report that might actually not be as inflationary as you would think, given all of the tariff threats that we've had over the last few months. Why?
It's simply a matter of timing. I mean, we have started to see a little bit of evidence of goods prices moving higher in certain segments of the economy. But the reality is that many of the tariffs that have been threatened haven't hit. They haven't shown up in corporations' supply chains, and therefore they're not going to show up in the inflation data. That's not something I expect to last. We do anticipate that goods prices in particular will be moving higher over the course of this year. And actually, I anticipate that the worst of that will be felt in Q4 and Q1 because holiday ordering for companies is starting around now, and that's where we tend to see goods price or goods demand the highest, and that'll be bearing out in the next few months.
There is this logic out there right now that our average tariff rate in this U.S. is much higher than where it was at the start of the year, and it will be much higher over the next couple of months than where it is today, presuming that Trump follows through on some of the tariffs that he's proposed. Have you found a way to sort of model that into what, not so much what the impact is on corporate bottom lines, but on the economy overall?
Yeah, so we can look at the elements of the economy or the goods that we expect to see higher tariff rates and see how that manifests in not only the prices that we would see in consumer prices. For example, we do anticipate that goods prices will be moving higher while services prices here in the next 6 months are likely to continue disinflation or stabilizing. And we can see what that might mean for consumer prices. What's really challenging is to benchmark what companies are going to do about that. Yeah. Because the reality that companies face is that they can push prices through to their consumers, but this is not the backdrop that we saw for companies in 2022 and 2023 when inflation was really problematic. Consumers don't have the same stimulus checks and other backdrops to support them through an inflationary period like that. And so we anticipate that there will have to be a balance between pass-through of these costs and also hit to corporate margins.
Well, so this kind of fast forwards us to this Thursday where we're going to get another retail sales report. And again, with the idea that it's a little backwards looking, may not incorporate the full impact of tariffs. But this idea that, at least up until this point, consumers continue to spend to some degree. I know there have been some components of softness in that spending. Where do you think, if we do continue to see that softness, it will be most evident?
It'll be most evident in areas like technology and consumer electronics, in durable goods, really in the capital-heavy goods that you and I have in our home every day. Luckily, those aren't goods that you buy all the time. And so it's really when we start to see impacts to things like imported goods like apparel, et cetera, where we'll start to see a more regular hit to consumer prices. But these are elements of the economy that are important. I think, it is a little bit early, as I mentioned, to see the impact of these tariffs priced into the data. But every report is live. And I think as we move later in this month, later in the summer, you have the Fed making decisions on data that's not only imperfect or incomplete, but also that they can do very little about. There's not a whole lot that a 25 basis point hike or cut, a move in either direction can do to stave off some of these threats.
But I am curious why you think the Fed hasn't tried to at least articulate what it might do next. I know you have the dot plot and, okay, maybe we get 2 cuts this year. But if you believe the president, we should be much lower, our interest rates should be much lower than where they are right now. Is there not an incentive or an argument for the Fed to make internally that maybe they should just start off with 25 basis points, kind of get the ball rolling just in case there is an economic downturn that they need to guard against?
I think based on the data that we've seen so far, and certainly what I read out of the June meeting minutes last week, they are starting to talk about that. The idea that the labor market is seeing cracks, they're seeing it, you're seeing it, I'm seeing it, and disinflation has been pretty much intact. In fact, if not for the policy risks ahead, I think it would be a pretty easy case for the Fed to make that they should be cutting right now. The challenge that they have is that there are these policy risks ahead, and there are risks not only to, that we've been discussing, to tariffs, for example, slower growth, higher inflation, but also to the labor market. We're seeing changes in immigration policy that are likely to reduce the size of the labor force here also in the next 3 to 6 months. That's a really challenging environment to be cutting rates into because we may see the unemployment rate actually moving lower, even as jobs creation stabilizes, and that could create wage pressures. The risk of a double peak in inflation really isn't behind us, and that has them on pause. The one last thing I'll say is that I think a tiebreaker for the Fed is financial conditions. And when you see financial conditions very healthy, markets doing really well, it's hard to make the case that the Fed is constraining this market in a way that's really holding back the economy.
Yeah, and I've seen that argument before, Lauren. I have to leave it there. Always smart. Lauren Goodwin, economist and chief market strategist at New York Life Investments, setting us up for that CPI report tomorrow morning, PPI the following day, and later in the week we do get retail sales. In between all of that, we're going to start to get earnings out of big banks. A conversation up ahead with Matt Stucky at Northwestern Mutual about what he expects out of this earnings season. This is The Close on Bloomberg. All right, big bank earnings are on tap. JP Morgan, Citi, Wells Fargo, among some of the more notable names set to report tomorrow morning before the bell. Joining us right now is Matt Stucky. He's Chief Portfolio Manager of Equities at Northwestern Mutual Wealth Management. And Matt does hold shares of JP Morgan and Goldman Sachs in his fund. Matt, thanks for joining us here. We're already talking about stocks overall, at least in aggregate, financial stocks that are pretty much at record highs, at or near them right now. We've seen a lot of investors pile into some of these names with the idea that the worst might be behind them and that some of the concerns about tariffs and trade policy, all the stuff coming out of Washington, that a lot of these names might be insulated to a certain extent from any negative impact from that. Is that how you see it?
Well, we have seen how policy uncertainty has impacted the banks a little bit during the quarter. If you look at April and May, those months were really slow from an investment banking perspective, but then they just shot up in the month of June. And so it does seem like the worst is behind us in terms of an activity perspective, which is the open question mark for some of the companies that are reporting tomorrow morning. Offsetting that is a really, really strong trading environment. If you look at fixed income volumes, those are up roughly 18% year on year. Equity trading's up roughly 54%. Options volumes up over 20%. And so there are some puts and takes heading into the print tomorrow morning. But all in all, it should be a pretty strong season for bank earnings.
Let's start with JP Morgan. Obviously, everyone pays attention to that, obviously, given its size and, of course, given its CEO, who certainly spares no punches when giving his thoughts here on economic conditions and policy conditions. We know the numbers are expected to look pretty good for the most recent quarter. What do you think, though, that Jamie Dimon and his CFO are going to say with regards to guidance going forward?
Yeah, I think the big open question, Romaine, is whether or not interest income is going to be revised higher. Consensus is already pushing 2025 expected NII up from 90 to 91 and some change in terms of billions of dollars with the net interest income. JP Morgan back in May at their investor day reaffirmed the guidance at 90. The question is whether or not they're going to up that with the release tomorrow morning. And so, those are the things that, to me, we're going to be watching out for. Of course, you want to pay attention to how the consumer is doing. JP Morgan has a massive credit card business. And so strains that may or may not show up there, those are not expected, but those are always watch items.
When you look at where the shares are right now, I think we closed today around $288, not far off that record high. And you look at the multiples underpinning JP Morgan. Does it look like a value at this stage, or does it maybe potentially look overvalued?
This is the big question here. JP Morgan, from a tangible book perspective, is trading almost 3x, which is near 20-year highs. But relying on a tangible book valuation just inherently is something you look to in tougher macroeconomic conditions when the environment is suppressing earnings. On an earnings basis, on a forward 12-month basis, it's a much more palatable valuation to get your head around. Trading between 14 and 15 times forward earnings against a market that's north of 22x. And so it depends on kind of your macro view in terms of how you would put a valuation on JP Morgan here. I think one thing that really has a lot going for JP is just the trend on the revision line item for earnings. That's up roughly 13% so far this year. And so JP Morgan's firing on all cylinders, and in those types of environments, valuations do tend to be higher.
Goldman Sachs, we get that the day after, Matt. I am curious as to whether the story there would be materially different than what we hear from JP Morgan.
Well, with Goldman, it's a little bit different, just more of a fee-based business, as net interest income only makes up around 15% or so of the business versus roughly half for JP. And so markets activity and trading activity is going to be more of an over-indexed line item for the firm. And so again, the business environment rebounding pretty quickly from the lows of April and May from an investment banking perspective and accelerating to June should be really impactful for the Goldmans of the world. And again, the trading environment has been really strong, and so that's a healthy offset there.
Looking a little bit more long term beyond this earnings season, Matt, I am curious as to what you think about some of the policies coming out of Washington with regards to financial industry regulation or deregulation, if you will, and whether that could actually be a tailwind for some of those names.
I think it could be, and I think this is maybe one of the reasons why, when we just had a conversation about valuations, why they are where they are. You already have seen a lot of SCB reduction for a company like J.P. Morgan and Goldman Sachs, but what hasn't been finalized yet is GSIB reform. Right now, J.P. Morgan is the highest of the group in terms of its GSIB surcharge, around 4.5%. That's scheduled to go to 5% at the beginning of next year, and then 5.5% beyond that. If we were to revert back to the first method, that when GSIB surcharges were first announced, that'd be a material lift in terms of capital requirements. And so those unknowns, I think, are tailwinds potentially to the valuation there.
All right, Matt, got to leave it there. Great stuff. Matt Stucky, Chief Portfolio Manager of Equities at Northwestern Mutual Wealth Management. A nice preview there of some of the earnings that we're going to start to get tomorrow, including from J.P. Morgan. When we come back, we talk fixed income. We talk the tariff roller coaster. We talk with Sara Devereux at Vanguard. At least on the day, bond yields a bit muted as investors really are trying to parse President Trump's policies and how they're going to filter through the markets. There is worry out there that high tariffs and, of course, Trump's pressure on Jerome Powell could push the 10-year yield above 5%. But our next guest says the second half of 2025 will be defined by the administration's pro-growth agenda. Sara Devereux joins us right now here in Studio 2, Global Head of Fixed Income at Vanguard. Great to see you, Sara.
Great to see you, Romaine.
It's funny, for all the hand-wringing over this market right now, I was taking a look at some of the year-to-date returns. If you had just sort of dove into the bond market at the start of this year and had the foresight to do that, in some cases, you'd probably be making out better than if you had dove headfirst into the equity market. I am curious, though, as to what sort of keeps, the good times, for lack of a better phrase, going for the rest of the year.
Oh, well, look, I think the driving macro theme year to date has clearly been tariffs. It's been a bit of a roller coaster ride. We're still on it. You think about that effective tariff rate. Last year was 2%. This year, Liberation Day, we hit 25%. Now we think we're coming down to we're going to settle in that 12 to 15% range. So materially lower than Liberation Day, but also materially higher than last year. We do expect continued noise around that number, but at this point, we feel like what is going to be applied in terms of the effective tariff rate is past the peak uncertainty, and now we're going to focus on how it flows into the real economy. We think it's a stagflationary impulse. It'll drag growth, it'll boost inflation, but the magnitude of each remains to be seen, and that makes it really challenging for investors and, frankly, for the Fed.
What are you trying to look for as you're trying to sort of assess what that impact is? What are kind of the key markers that's kind of in your brain right now?
Yeah, so we're really watching what the Fed's watching. We're keeping an eye on, the Fed's trying to be patient with all that policy uncertainty that's playing through, and how is that going to flow into the greater economy? With tariffs, where's the impact going to be? Is it going to be exporters that bear that cost? Is it going to be U.S. corporations that bear that cost in the form of narrower margins? Or perhaps it's the U.S. consumer in the form of inflation? And so the Fed is going to wait and see, how those things pan out. And we think it's smart for them to talk tough on inflation. But we have no doubt that if there's any material weakness in the labor market, that they'll come in and they'll cut rates perhaps substantially.
Are you confident right now, given recent events, in the Fed's independence, their true independence to make decisions?
Yeah, absolutely. Look, we think it's critical for the Fed to remain independent. We think they will remain independent. And for now, they're really just focused on the task at hand, their dual mandate.
When you look at least in the Treasury market, right now, there does seem to be a bet on lower rates. Not necessarily tomorrow, but certainly over the next few months into next year. Do you think that's warranted, based on what we know right now?
So I think we're thinking of it this way. There's a lot of uncertainty out there. We think it's a good time to be disciplined. Discipline delivers. Look through the noise, focus on the long term, and build resilient portfolios. To that end, we do think it's a great time to add fixed income to your portfolio as a strategic stabilizer. And really that's across 3 pillars of value. Yields are attractive, versus history. Secondly, there's that income component, right? The income is back. That means bond prices don't have to rally to get a great return. You can clip a coupon. And third, those diversification benefits are really valuable. We think about equity valuations, kind of lofty here, slowing growth. The Fed could cut rates. It's a really good idea to have that insurance in your portfolio.
When you talk about that coupon clipping and the idea that you are getting a pretty healthy yield, it's certainly relative to, I don't know, just even 2 or 3 years ago.
Yeah, for sure.
I do wonder how much duration risk you would recommend taking. Do you go out and do you buy a 10-year, or do you buy a 30-year, or do you just sort of, buy a 2-year at 3 point whatever it is, and then just roll it over every couple of years?
Yeah, no, I love that you're thinking about you could get a 4% return on a 5-year treasury. Just a few years ago, you had to go into high yield or private to credit to get that kind of yield. And for so long, we were at the zero lower bound. So
with a lot of risk attached.
With a lot of risk attached to it. So it's exciting to have yields where they are. But as far as where to be on the curve, we really like the belly of the curve, right? We think that is the best balance between income and duration. Long end has that term premium risk, 20, 30-year point. We're going to continue to see volatility there. And by the way, the short end also has risk. The second that the Fed cuts rates, that income will evaporate in the money market fund. So we're really encouraging investors, you don't have to go that far out the curve. Just get to that 5-year point or so, right into the belly, and lock in some of those attractive yields.
What about corporate credit? I mean, yields are, or I should say credit spreads, more importantly, are relatively narrow, and certainly narrower than I think what a lot of people thought they would be, given some of the concerns about tariffs and the economy. Do you think that will last, that narrowness will last?
So, within credit, this is, again, where we think discipline really delivers. We believe it's good to be up in quality. There are attractive yields to be had. All-in yields are attractive, but spreads are tight. So we're really leaning into security selection, and we are keeping some dry powder on the side to deploy if spreads should widen. We're also pairing our IG overweight with long duration in the belly of the curve. Really, it's like you call it a recession insurance. Should we hit an air pocket and hit a recession, it's our own 60-40, if you will, a bit of hedge to our IG credit. And finally, we're thinking about policy proofing those portfolios. In IG credit, I would say go overweight the banks. You're going to benefit from deregulation, and we're trying to stay away from the tariff-impacted sectors such as autos.
So we were just talking a little bit earlier with the economists over at New York Life about the inflation report that we're expected to get tomorrow.
Yes.
And no one's expecting a material increase, but there is concern over time as the tariffs do kick in that we will see inflation. So going back to clipping the coupon, going back to some of the pricing you get in this market, when you start to factor in inflation, what ends up being the level that you're looking at that is still attractive?
So look, real yields are really attractive right now. I think at a 2% real yield, that's net of inflation, which is pretty high. We're looking at the report tomorrow. We're kind of right there with consensus. We think we're going to start to see some of that tariff impact feed through into inflation. And our year-end forecast for core PCE is around 3%. We would have been getting down close to 2% if it were not for tariffs. But notably, for next year-end, we're back down into that 2.2%. So I think tariffs can be that one-time price impact, if you will, and then base effects will kick in, and we'll be right back down to that lower 2% area. And look, I'll go back to the Fed. They've got to keep inflation expectations anchored, right? And so for them to talk tough when it comes to inflation is exactly what's going to keep the tariffs as a one-time price bump and allow them to cut if they need to, if the labor market starts to slow.
You obviously sit in a great perch, kind of overseeing everything at Vanguard on the fixed income side, and Vanguard, of course, being the 800-pound gorilla in pretty much every market. Did you see, or did you get any sort of a taste of any sort of material wholesale abandoning of the U.S. market? Back during Liberation Day, there was all this talk when we saw the ructions in the Treasury market that, all these foreign investors must be selling off. And I'm not sure the data ever proved that, though that did seem to be the narrative. And I'm wondering what you saw back then and even right now.
Yeah, absolutely. So look, there was a lot of volatility in April around Liberation Day. I think when it comes to foreign selling, it was a lot more fear than actual flow. We were not able to substantiate wholesale foreign selling, right? I would also note, by the end of April, like bonds did their job. Year to date through April, if you look at the aggregate index, it was up about 3%, with stocks were down 6%. And also in April, Treasury flows were higher than we saw in March of 2020. And the market was resilient. So the pricing moved around a bit, but the market, was resilient through that period. When we're thinking about supply and demand of U.S. Treasuries, and you're asking specifically about foreign, I will point out, we did not see any selling in April, but I will point out over the long term, the landscape of demand for Treasuries has absolutely shifted. Foreign investors used to own 65% of coupon Treasuries, right? And now they own about 30%. Their footprint is materially smaller. Same with the Fed. They're doing QT. Their footprint is materially smaller. So that leaves, the remaining landscape of demand is a little more price sensitive, right? And that's also what's driven a bit of that term premium rebuild.
Where's the new demand coming from? Are you seeing a lot more demand on the retail side? I mean, people that maybe weren't or didn't have a meaningful allocation to fixed income, a year or 2, 3 years ago?
Yeah, absolutely. So, with the Fed and foreign investors being, less of a bid for the Treasury market, really the marginal bid are those price-sensitive investors. It's asset managers, it's hedge funds, and entities like us. Like, we're going to demand more return, right? That's exactly why the term premium is up about 100 basis points since late last year, right? So investors are now getting paid to go out the curve, and I would also note that, on the flip side of that coin of there's more supply is also that term premiums rebuilding, the administration is really aware of that 10-year point. Secretary Bentsen's called attention to the 10-year point specifically, and we've seen policymakers really put their money where their mouth is on Treasury market resilience. SLR reform is in question, right? So the banks can sponsor Treasuries. QT has been slowing. That means less Treasuries in the marketplace to trade. And, at the end of the month, we're going to get a refunding where, it's possible to change some of the issuance patterns to sort of control the long end of the curve.
With those issuance patterns and more importantly, the demand that this country has right now to service its debt, and do you anticipate that the strategy that Bentsen is taking, at least the one he's articulated somewhat publicly, the idea that it is going to be much more the shorter end of the curve, and that we could see a lot more issuance there. And are you at all concerned that could maybe distort the overall Treasury market to a certain extent?
Look, I think there's many tools in the toolkit to sort of, keep an eye on and keep a lid on that term premium, if you will. And there are really, a variety of things coming out. As I mentioned, increasing sponsorship with SLR, slowing the QT, and issuance is one of those tools in the toolkit, right? He said very publicly, we don't want to term out the debt anytime soon, which implies maybe more issuance comes on the short end. And we do believe that there is good and solid demand there as well.
All right, Sara, great stuff, and really great to have you here in studio. One of the best in the business, Sara Devereux, there, Global Head of Fixed Income at Vanguard. All right, let's check in back on the markets here. Green arrows across the screen, but modest gains to be sure. Modest outperformance today by the Russell relative to the broader index, but you continue to see pretty decent strength in financials, up as a group about 0.7% heading into earnings season, which ostensibly kicks off tomorrow. JP Morgan, Citi, Wells Fargo, among some of the names reporting. Of course, full coverage tomorrow morning on Bloomberg Surveillance as soon as all of those earnings drop. Stick with us. We'll be back here on The Close in just a second. This is Bloomberg. All right, let's take a look back in history to the year 2010, when the U.S. Senate passed the biggest overhaul of financial regulations since the Great Depression. The Dodd-Frank Act, a top-to-bottom rewrite of rules governing Wall Street firms, was ostensibly intended to prevent a repeat of the economic calamity from the 2008 credit crisis that felled Lehman, Bear Stearns, and Washington Mutual. The bill at its core created a mechanism for liquidating failing financial firms, created a council of watchdogs to police economic threats, and created a consumer bureau at the Fed to monitor banks for mortgage lending abuses. The House of Representatives approved the bill June 30th, followed by the Senate on July 15th. And a few days later, on July 21st, in a splashy bill signing ceremony, President Barack Obama heralded the new rules as providing the, quote, strongest consumer financial protections in history. Now, measured against the Wall Street excesses that had just kneecapped the global financial system, some analysts said Dodd-Frank was too soft. Financial companies, of course, felt the law was too strict. And Obama's signature simply started the clock on years of partisan wrangling and lobbying to water down many of the provisions. After years of chipping away at those legislative measures and slow-walking the regulatory changes, critics of the bill, they finally got to take a real swipe at it in 2018 when, a little more than a year into President Trump's first term, Congress passed a massive rollback of key tenets of Dodd-Frank, including raising the bank asset threshold in a way that absolved companies like American Express and SunTrust from higher compliance costs associated with being considered too big to fail. And now tomorrow, on the 15th anniversary of Senate passage, Congress is holding a hearing to discuss, quote, the lessons learned and the road ahead for Dodd-Frank. A curious, if not apt, title, given that a decade and a half later, major provisions are still being contested, and believe it or not, other provisions have still yet to be rolled out. And someone set to testify at that hearing tomorrow is Ken Bentsen. He is the president and CEO of the Securities Industry and Financial Markets Association and a former member of the House of Representatives, and he joins us right now. Ken, great to see you here ahead of the hearing tomorrow. I don't want to sort of relitigate the sort of origins of Dodd-Frank. I think we can all agree that something was needed coming out of the financial crisis. But as you look back 15 years later, Ken, is there an argument to be made that maybe Dodd-Frank has run its course?
Well, first of all, Romaine, thank you for having me. And a couple of things I would say. First of all, it's good that the Congress is having the hearing. Congress often passes legislation, I know this from personal experience, and always says, we'll come back and look at it, and doesn't get around to it. But so this is an appropriate hearing to have. And I think also we shouldn't look at this as sort of a binary choice. There's no question that many of the reforms that went into place in terms of capital and liquidity have certainly created a more resilient system, particularly with the large, complex banking organizations who are also very important in our capital markets, which, of course, capital markets are hugely important to the operation of the U.S. economy. But at the same time, we know that some of those rules and requirements were overly stringent and have constrained banks' abilities to finance markets. And, you know, I thought the conversation you just had with Sara Devereux overall was outstanding. But in the discussion about the Treasury market, you know, we've seen exponential growth in the Treasury issues outstanding. And at the same time, primary dealer balance sheet has remained flat, which creates issues. And part of that is because of the requirements of the legislation. And we still have things to do, as you said. We still have the Basel III Endgame and the fundamental review of the trading block that, as originally proposed, would be quite punitive to banks' ability to engage in financing in the capital markets, and that would be a detriment to our economy.
I am curious then, I mean, given the new administration and an approach that they have taken to the financial industry that certainly seems a little bit less onerous than maybe the previous administration, do you think there would be a meaningful opening to go back to Congress and actually redo some of those provisions, if not the entirety of the legislation?
Well, I think they should. I think there are certain things that we can look back and say they worked or they didn't work. And again, it's not a binary choice. It's not all good, all bad. It's some stuff worked, some stuff didn't work. And so you look at things like the Collins Amendment, which sets a minimum floor that really exceeds where other jurisdictions are. And that's, again, a problem for the U.S. because we rely on our banks to engage in financing in the capital markets, and we don't want to hamstring that because that's so important to our economy. Similarly, as I noted, finishing off the capital rules, Basel III Endgame, I don't know that Congress needs to go back and change that, but I think it's good that the Fed is going back. They're having a conference next week that look at all the capital and liquidity rules that have been done and then inform their decision on how they're going to go forward to close out a proposal that's been out there, since Dodd-Frank passed.
I mean, you as head of SIFMA, I mean, you represent the broker-dealers, a lot of the investment banks and asset managers. What is the number one thing that they're asking for, or that they're asking for you to go around Washington and make it clear that this is what they need? Well,
I think it goes back to constraining the ability of firms to engage in the capital markets business. We finance 75% of commercial activity in the U.S. in the capital markets, which is the inverse in Europe and Asia, who would like to build their capital markets in the same way that we have ours. I was just in London and Paris last week on business, and both the EU and the UK are seeking to dramatically grow their capital markets as opposed to everything going on bank balance sheet. So we need to be protecting that asset that we have in the U.S. And that a lot of that comes down to what we do on these capital and liquidity rules that were prescribed in some cases by Title I of Dodd-Frank. So that's really the first place to start. I think beyond that, we can go back and look at some of the rules that were promulgated in the swaps area, in the mortgage area, that perhaps well-intended but overshot the mark. So I think there are a number of recalibrations that can be done. And then lastly, I would say, with respect to some of the tailoring that was done before, our foreign banks, which play a very big role in the U.S. capital markets, have really been put at a distinct disadvantage to deploy capital in the U.S. And so I think that's something else that Congress should take a look at.
Now, I know you're no stranger to testifying on Congress, and obviously you were a member of Congress yourself for several years. You're going to get some pushback from a certain side of the aisle on a lot of these issues, Ken. The idea that some of them will try to make the argument that without these provisions, as they were originally intended to be, that somehow our financial system would be more at risk, our economy would be more at risk. What would be your response to those concerns that these protections are there for a reason?
Well, first of all, it's not a binary choice. It's not an either-or choice. It's what makes the most sense. So no one's talking about ripping Dodd-Frank out from its roots. We certainly aren't. But it is thinking about before you add things on, which the original Basel III endgame proposal would have done, we should go back and look and see what we've done now and what's worked and what hasn't worked. And we should be thinking about what's going to be not just providing resiliency and safety and soundness, that's important, but also what's promoting economic growth. And again, the U.S. relies heavily on its capital markets. It's served us well. We should be thinking what we can do to promote that.
All right, Ken, I really appreciate you joining us. Ken Bentsen there is President and CEO of the Securities Industry and Financial Markets Association, SIFMA. He's scheduled to testify tomorrow at a hearing on Capitol Hill, revisiting Dodd-Frank on the 15th anniversary of the Senate's passage of that landmark bill. We're going to set you up for some of the other potential market-moving things that could occur over the next 24 hours when we come back. This is The Close on Bloomberg. All right, here's what the markets are going to have their eyes on over the next 24 hours. We start overseas and we start overnight with economic data out of China, GDP, retail sales, and industrial production for the world's second largest economy. Meanwhile, back here in the U.S., earnings season really does get into swing. Prior to the market open, we're going to get reports out of J.P. Morgan, Wells Fargo, Citi, and BlackRock, just to name a few. And once the market closes, J.B. Hunt and the ad agency Omnicom are set to report. A read on the economy that will be punctuated by a report at 8:30 a.m. Eastern Time. The U.S. CPI data, the latest read on the Consumer Price Index, and the one that is supposed to be the first to show any sort of material impact from the Trump trade tariffs. And Fed speak. In fact, the Fed only has 4 days to speak before it has to go into a blackout period ahead of its next meeting. So they're going to cram it all in. Bowman, Barr, Barkin, Collins, Logan, just some of the names scheduled to speak tomorrow during the day. We'll have full coverage of that right here on Bloomberg, along with any other market-moving news. We'll be back tomorrow. This is The Close on Bloomberg.